I've been trading daily cycles for a very long time, and over that period of time, I've made a whole bunch of mistakes which have cost me a whole bunch of money. Now, fortunately, I've learned from them, and today I'm going to be sharing those lessons with you so that you can avoid the mistakes better than I did. So let's get right into it. The first mistake I want to go over may seem a little bit obvious to you, but it's monumental when determining the results you get from trading daily cycles. And this mistake is having no higher time frame bias to back up your trade. So instead of having, a top-down analysis that you do where you start on the weekly, maybe you go down onto the daily chart and then you drop down onto the 4-hour chart to get a good idea of where the higher time frame is going and then sticking to that. Instead, you're basing your trades off of intraday price action alone. This is the 15-minute chart. Maybe you just use the 1 hour, maybe you just use the 5-minute, but essentially whatever happens on the intraday here is going to give you your judgment on whether price is going to go to the upside or it's going to go to the downside. And this is a huge issue when you're playing daily cycles. Let me explain why. So let's say, for instance, you're anticipating a London protraction cycle where Asia is meant to consolidate and then London kill zone takes out that Asia liquidity before moving towards a target. Let's say that you're anticipating that as the daily cycle. If we have a look at this example on the left, you can see that it's a perfect example right now, right? Price has taken out Asia high, formed a high in London, and now we're expanding to the downside. So let's say you were to get in on this trade. That is perfectly fine. This is a perfectly good example of a London protraction cycle. But once price reaches Asia low, like this, you're going to run into a few issues. If we're going purely off of daily cycles, you would say now, okay, we've had Asia low being swept by London kill zone, and going off of the rules for the daily cycle, you could very well predict that price is going to react from here and reverse and give us a bullish impulse. And if you genuinely don't have any conviction in a higher time frame bias for either direction, you're going to close the trade that you got into up here early, right? You're going to close it prematurely when we reach Asia's low. And you're also potentially going to try to get into a buy position below Asia low, right, to reverse in the opposite direction, which, as you can see in this example, fails, and in many other examples is also going to fail. Now, the issue with trading this way, where you're expecting a reversal at both sides of Asia just to purely satisfy the daily cycles, is you're essentially saying that you're expecting the market to do this, right, which is reverse at every level of liquidity, which is simply a seek and destroy market condition, which we know is a low probable condition that doesn't occur as often as, clean trending markets. So it doesn't make sense to try and trade like this. So what we want to do instead is a top-down analysis and identify a clear target for the market. It's only ever going to do one of two things. It's going to target external range liquidity like an old low, or it's going to come back and target internal range liquidity like an FVG or some kind of inefficiency. It's only ever going to do one of those two things. So we do a top-down analysis and identify one of those clear targets. So the weekly here, we've had 3 consecutive bearish candles. We formed this bearish order block up here. So I would say it's in a sell program. And in terms of targets, we're in close proximity to this old low here, which is external range liquidity. If we go onto the daily, you can also see we're printing a lot of consecutive bearish candles. Bearish order flow is holding. We have disrespected this bullish FVG. So again, I would say that this is a sell program on the daily in line with the sell program on the weekly. So again, we're likely to target this low down here that we're close to. If we go on to the 4-hour, price also backs this up, right? We've been respecting bearish PD arrays, right? We respected this FVG here, and we've respected this FVG here. So we have 3 time frames all in alignment, right? They're all bearish. The weekly, daily, and the 4-hour are bearish. So we have a bearish higher time frame bias. So we really should only be looking for sell opportunities. So if we're looking for a London protraction cycle, we're going to be interested in selling above Asia's high. And when price reaches, Asia low, we're not going to be expecting a reversal, right? If we do get some kind of entry, like a market structure shift or whatnot, underneath Asia's low, when a higher time frame bearish bias, you're simply going to expect that to be some kind of inducement, a fake out to grab more liquidity before moving to the downside again, right? That's all you're going to anticipate when that presents. For example, looking at this EU trade, right, we had a sweep of Asia's low down here. Potentially you would navigate an entry within there, and then price goes and we target Asia's high. right? We take out Asia's high. Now, potentially, once we take that out, price is going to offer some kind of entry. You can see here, we actually do get a market structure shift. I use slightly different confirmations for my entry, but this is still valid for a lot of people's rules. So we get a market structure shift. Potentially there you'd say, okay, London protraction. As you can see, it was a liquidity sweep, a fake out, an inducement to then go and continue running to the upside. And the reason you would anticipate that being a fake out is because if we go onto the daily time frame, for instance, overall we have a bullish higher time frame bias. The daily's in the buy program. We had this level of external range liquidity that got targeted within the day that I just showed you. If we went onto the weekly time frame, you'll see the weekly is also bullish, right, with respecting bullish order flow. So we have that higher time frame bias backing up the idea, right? It's not just the daily cycle alone. We need the bias as well. And by having that, you're going to have conviction in your trades, right? You're going to have a lot of confidence in the decisions that you make when you decide to stick with a trade because you have data backing it up. Mistake number 2 when trading daily cycles is not having an aggressive sweep of liquidity. I used to always get frustrated with myself when I made this mistake because in the moment, I found it hard to recognize the mistake that I was actually making. Obviously, now I've learned from this. So yeah, let me break it down for you. Now, all 8 of the daily cycles that I use rely on a sweep of liquidity. So for this example, we'll talk about a New York reversal, which is essentially where London consolidates or we build up some kind of liquidity in Asia and London. And then New York kill zone comes and takes out that London low as the liquidity for the move before expanding to the target. Now, this sweep of liquidity here has to be fast and it has to be aggressive. Let me explain this to you in an example. So here you can see we have London's low, right? And surrounding that, we also have a bunch of relative equal lows, right? All of these lows here are relatively equal. So that is also a level of liquidity. Common misconception about liquidity is that it resides under specific levels, right? It resides under this London's low here, and it resides under these equal lows. And they're the only 2 levels for price to reach for to get that liquidity sponsor. But in actuality, it is a pool of liquidity, right? Potentially from here to here, right? And at every single level within that pool, there is liquidity for price to get through because there'll be orders at every single one of these levels. Think about how many orders there are in the marketplace. They're not all going to be here and here, right? They're going to be built up in a pool of liquidity, okay? So what do you think the best way for price to come and take out this pool of liquidity would be? Do you think that it would be best for price to work its way lower very, very slowly, working its way through that liquidity like that? Well, the answer is no. And by price doing that, it's like trying to, stab something with a knife that is completely blunt. Instead, what we want to see is a fast and aggressive move through the liquidity pool like this, right? That is what we want to see. And it is a telltale sign that the market is purposefully manipulating liquidity, which is what we want to see. And if I let this play out, you'll see that price in 2 candles, or 1 candle actually, sweeps all of the liquidity, right? We take out London's low, we take out these equal lows here, and yeah, we've pushed our way fast and aggressively through the pool of liquidity. And then from here, you'll see that price reverses, and then we go to the target. Now, if I was to put on the kill zones, you'll see that this is that New York reversal cycle, right? New York took out London's low and expanded to the target. Now, the reason I used to make this mistake and get so frustrated about it, not being able to know what I'm doing wrong, is because I wouldn't take notice of what was actually going on, with the price action within the kill zone, right? So if I was to scribble this out, I wouldn't acknowledge what was actually going on within the kill zones. I would just see that, the orange box, London kill zone, has taken out the purple box, which is New York kill zone. I would take that at face value as the sweep. But this is essentially pattern trading. So what you want to make sure you're doing is, even once we do get New York taking out London, is you want to make sure it has the characteristics that we're looking for, which is an aggressive sweep. So you want to know whether price has given that fast aggressive move or whether it was slow and choppy. And obviously you can see that this one meets the criteria very, very nicely. Now, this last mistake is huge and was monumental to me becoming profitable. I actually remember when I first recognized this mistake, learned from it and fixed it, was actually the turning point in me going from a break-even trader to a profitable trader. So this could be very, very big for you too. Very quickly beforehand, I want to show you this flowchart I put together for you that you can access completely for free. It's going to take you step by step in identifying the daily cycles. You can see here we have London session. You follow these steps to identify the London daily cycles. And even at the end of it, I've included my entry criteria that you can still do. And then if we go down here, we have New York session. Again, it's going to take you step by step in identifying all the New York session daily cycles. And at the end, I include my entry criteria that you can steal. Now, if you want to access this completely for free, I'm going to leave a link to it in the description so you can go and get that. Now, this last mistake is holding trades through unanticipated times, basically ignoring how the daily cycle should actually form. So let me explain this a little bit better with some examples. So let's say we're trading a London protraction. We get Asia consolidates, London kill zone takes out Asia's low, and we're now anticipating price to impulse to the upside, right? That's what we want to capitalize. And you get into a trade, but instead price moves very, very choppily, and you end the session around break even, right? Let's say, for instance, it happens in New York as well. London impulses, we get a retracement. We're expecting New York to continue, but instead we get into a trade and price just moves very, very choppily. And at the end of the session, we are around break even. Now, when this used to happen to me, I used to just hold the trade and hope that we got the impulse towards my target outside of these sessions. But this was a mistake, right? And obviously I wasn't profitable when I was doing this. And a couple of things that you have to understand. Just because price hasn't hit stop loss yet, because we haven't hit stop loss, that doesn't mean we aren't in a losing trade. Price has not done what we expected it to. So the daily cycle has failed. Maybe you're not at stop loss yet, but the daily cycle has failed. So that's one thing that you have to understand first, that it's not actually played out as you anticipated. Now, the next thing that you have to understand is by hoping price pushes to the upside outside of session timings, is you're relying on luck. You're now operating outside of your back-tested data. Because when you collected examples, for instance, on London protraction, right, if you've collected examples, or when you've collected examples on New York continuation, right, you're looking for them to look picture perfect. The examples that you've collected, right, we get the impulse in London kill zone. You get the impulse in New York kill zone. So by operating, outside of your back-tested data, you're relying completely on luck. So instead, when you're presented with this, what I do now is if price has moved choppily throughout the session and we're around break even at the end, you just close the trade. It wasn't what you was anticipating. You get out at break even, you don't take a loss. Same if it was New York, right? If we consolidated, we get to the end of New York, just close the trade at break even, right? There's no loss there and you're sticking with your back-tested data. Now, this is very important. The technical side is very important. But I believe what was more important for my growth was actually having the psychological switch to now actually being able to recognize when I'm relying on luck and when I'm relying on my back-tested data, because that now applies to everything. If it's not within my data, if it's not back-tested, you're gambling, and that will help you stick to the probabilities and not take losses that you shouldn't have even been trading in the first place. Very quickly, let's have a look at a real example, because I know you want to see one. So we had London impulsing, we had a retracement back into London. Price has taken out this old low here, so you have liquidity. Potentially you get into an entry down here, right? For argument's sake, you get in there, stop loss is there, and you anticipated a run to target up here. Instead, price moved away from your target, returned back to the entry, and then we get to the end of the kill zone, right? The kill zone has ended here. It ended actually at the break even, right? So let's say you're in that situation. I would used to hold, but now we know, right, that the session has not played out as anticipated. We anticipated a run in New York to reach target around the end of session times. Instead, at the end of session times, we're still at entry. We haven't gone anywhere, so you should close the trade. If you decided to hold on, you'll see that price ends up actually hitting your stop loss when you could have got out at break even. As a daily cycles trader, these are 3 key lessons that I had to learn the hard way that hopefully now you don't have to. Now, if you are interested in learning all 8 of the daily cycles, getting access to 6 in-depth courses, case studies, and more, then you can start learning all of that for free today. I'll leave a link to that in the description so you can go and access it. Now, as usual, I hope you found value in this video, and I will catch you on the next one.